The other one is Ujjivan, very good quarter. Sudha Suresh, Managing Director and CEO at Ujjivan Small Finance Bank, joins us right now on the show. Mr. Suresh, thanks so much for taking the time out and joining us on short notice, I might add, but good having you today. Sum up the quarter for us. You would be very happy with the performance. Give us a breakup of how the growth has happened in the MFI portfolio versus the non-MFI portfolio, and how do you envisage FY19 to be like?
Good morning, and definitely it has been an excellent quarter for us, closing with a PAT of 64.9 crores. I think this is totally due to the combination of for the quarter. Having said that, we have also seen across various verticals, our group loans year on year have increased by 56.3%. Our micro individual loan has shot up by 54%. Our MSE loans increased from quarter on year on 64.5%. And of course, affordable housing with a very small base had an increase of almost 244%. So overall, we have clocked a portfolio of about 7,560 crores, which is an 18.5% growth over the previous year.
Okay, Suresh, I'm having read through what the street is wanting to know from you. Just 2 or 3 questions there. We'll make this short and quick. People say that your ability to reach your previous glory days, which would mean ROA northwards of 2.5%, ROE northwards of 15% would hinge dramatically on 2 things. One is on whether or not you can garner the low-cost deposits in a meaningful way, and how efficiently can you control your operating costs. What do you think the guidance is out there, not just for the next 6 months, but for say 3 years out?
So you're very right, as the expectations are that having converted into a small finance bank, our parameters for reaching the ROE of 2.5 and those pre-17 plus ROEs and ROAs of 2.5 would definitely hinge on seeing a very strong deposit base that we build up over the next few years. As you're aware, we already have a base of 37 lakh MFI customers, and we have also forayed into the other segments of MSE and housing. Overall, we have converted about 187 of our existing branches into full-fledged banking outlets, and in FY19 we expect this conversion to reach almost 475 full-fledged banking outlets. With that, we would be able to set up and increase our focus on retail base, and we are looking at almost building 2,000 to 2,500 crores in terms of our retail deposits in this financial year. And definitely, this being the second year of a strong foundation for the small finance bank, we do expect the economies of scale and synergies to give us a rapid ramp up in the next 3 years post FY19, and so we would definitely be able to reach our goal and mission as we see of becoming one of the best mass market retail banks and achieving the kind of ROAs and ROEs that we have set up for ourselves.
Is there a guidance you can give me? Operating costs, or cost to income ratio, let's say, which has dropped quarter on quarter YOY. What's the trajectory there? 2 years out, 1 year out, 6 months out?
Okay. So if we look at the operating income ratio, we would like to indicate that this is the second year of a foundation where we are largely converting many of our asset branches into full-fledged banking branches. As I said, the number is going to increase from 187, which we closed in March 18, to 475. So therefore, you would see an effective OPEX cost also hitting us in FY19, and definitely quarter on quarter there could be ups and downs, but overall for the year FY19 we would have largely the cost of we largely have the cost to income ratio moving up for financial year 19. But post that, for the next 3 years, as you have asked for, the guidance is that our cost to income ratio would decline and dip steadily, and over the next 3 years we would expect that it would come largely to around 50%.
50%. Okay, and you don't believe cost of funds will be an issue. Okay, one small question. Equitas, and I'm not comparing the two businesses, I'm just saying in a similar space, Equitas, when we spoke to them a few days back, said that they believe for a 5-year period a CAGR growth of 30 to 35% on the book does not seem to be an issue, does not seem to be an impossibility, in fact seems to be a certain possibility. Would you reckon that such a pacey, chunky growth CAGR for next 5 years for you as an SFB is possible?
We definitely believe that the average 30% CAGR is possible year on year and for the next 3 years. And this comes especially because there's a huge potential in the market, both for the MSE and the housing segment. We are also diversifying further into various products, and the microfinance business would also grow steadily. So this 30 to 35% is definitely a doable.
Okay, and you would believe that this can happen while maintaining asset quality or improving asset quality. Asset quality will not be at a small risk because of the pace of growth that you are targeting.
So we would like to indicate that since we are building up on our largely on a secured portfolio, to that extent there is a mitigation of risk in terms of any kind of asset quality downslide. Having said that, as we grow our MSE, we would ensure that adequate credit cost provisionings are there. But overall, we do expect that the credit costs will be on a very normal level, and we would be able to ramp up and maintain our excellent asset quality, which is at 99.6% for the MFI business continuously.
Last question, ma'am. You would have guessed I wouldn't do the interview without end the interview without asking this question. This impact of the farm loan waiver, which has been the talk of town. What are your thoughts here?
So, as I was indicating, this farm loan waiver which came from the BJP manifesto in Karnataka, we've been facing this over the last 1.5 years across 4 states, be it Karnataka, then there was Uttar Pradesh, there was Punjab and Maharashtra. And over the last 1.5 years, we have seen our experience that our portfolio quality has remained unaffected. Firstly, because we are largely an urban MFI, and also as we move into the semi-urban and rural, our portfolio in the agri is minuscule. So if you look at even Karnataka, we are largely the urban side, and basically on the agri side we have a very minuscule portfolio. And our past experience says that largely we remain unaffected because of any kind of these waiver manifestos, which have their own course in terms of execution or implementation.
Okay, leave it at that, Mr. Suresh. Thank you so much for taking the time out and joining us, and all the best. Congratulations firstly on such a good quarter, and all the best for the quarters ahead.
Thank you so much.
That's Ujjivan Financial Services and a hopeful and a confident management. With that, it's a wrap on this leg of Indian Open. Up next is the FNO show. Thanks so much for watching.